Hi, welcome to another episode of the FutureView Fireside Chat. I'm here with my colleague Brian McGrath, and today the topic we're going to talk about is how finance professionals look at financial statements. What do you look at first? What do you how do you evaluate them? What means stuff? What doesn't mean stuff? And I guess this could go two ways, because you've got sort of the financial statements of a company, a private company that usually are more meaningful, or you have the public company financials, which sometimes are indecipherable, as you well know. So I'll tell you one story. I remember being on a roadshow for the first day of the IPO roadshow, and we ended up with this big financial institution, but the guy who was hearing us, apparently there was some conference, and so all the people who knew our space, it was the e-commerce space, were out of the office that day. So he got saddled to listen to us on this thing, and he made no bones. He goes, "I don't know anything about your business," and he goes, "All I have is this," and he bangs a copy of our S1, and the S1, with all the financials down on the table, and he goes, "You know how I read this?" And I'm looking at him, and I'm like, "No." He goes, "I read it from the back to the front." And I said, I just clicked. I said, "Oh, kind of like the Torah." And that got us off to a great start. I don't know if they ever bought stock, but anyway. So the question is, how do you read it? I hand you let's start with that. You're looking at a company. Maybe you pull up their annual report, or what do you look at first?
I mean, the first thing I try to do, it's not statement specific. I just try to orient myself to the business, right? I look across the statements, and I'm looking for concentration of activity, right? I'm looking to help scale, help me understand kind of the scale of the business, what phase they're in. So scale meaning, revenue, expenses, top line numbers, just trying to get a sense of the business. Where are most of their assets and liabilities concentrated on the balance sheet? If it's a SaaS company, what's their funding look like? Where are they investing? What's their growth trajectory look like? Things like that. And then the cash flow statement is critical to understanding, the cash performance of the business, obviously, and where they're investing the money that's being put to work. And so where I spend more time from that will depend on what I find there, but I'm trying to just orient myself around how the company is deploying assets and what those assets are doing, and where the funding is coming from.
Okay, you're much more analytical than me. The first thing I look at is revenue. How big is this stupid thing, and then go from there. But which sometimes is meaningful, other times is not meaningful. I mean, I've seen companies I actually had a company once where the revenue was lower than the net income because of the way the accounting worked, which didn't tell you very much. But
again, it obviously depends on what stage the company's in. But when I look at a company, the reason I tend to go across all three statements is, I may be looking at a company that just raised a Series B or a Series A, right? And they don't have a lot of scale yet, but they're investing a lot in terms of people and technology, development and that sort of thing. Then you get to the balance sheet. We got $25 million sitting on the balance sheet, or something, right? And it's like, okay, now I understand the stage that this business is at, which means I understand how to further analyze, that the things that I will need to further analyze to understand kind of the next layer of the onion.
Or the companies where you look at the P&L and it looks pretty good, and you're thinking, wow, this is great, and then all of a sudden you glance down and you're like, holy cow, they got like this much debt, multiples of revenue and debt.
They got, they're burning cash, and they've got a lot of debt. Those are all data points that help assess what to do next.
All right, Brian, here's a question for you. You got three basic statements, right? Believe it or not, I remember back when there were only two. I think they incorporated the third one, the cash flow statement. You got balance sheet, income statement, and statement of cash flows. Which are your two favorite? Which two would you have if you only could have two of the three?
Statement of cash flows and P&L. Statement of cash flows first, because I can get a view of what's happening with the business across all three statements from that at a summary level, and I know where they're investing, which tells me what it tells me a lot about the business and the health of the business from an investment standpoint. And then the P&L describes that activity in a more nuanced way.
I completely agree with you. With the only exception, I was thinking if I have an income statement and I have a balance sheet, in theory, I can calculate a statement of cash flow. Mm-hmm. But the truth is, and we see this all the time with smaller mm-hmm. companies especially, the ability to build a statement of cash flow is kind of a lost art now.
It is,
I mean, it's hard. It's also hard to think about cash flow statements the way people, I mean, you kind of got to orient yourself to, okay, that number is a negative because we're generating mm-hmm. cash from this. And, it can be an interesting...
Yeah. Yeah, I mean, there's obviously value in all three of them, but at the end of the day, I'm a big proponent of the idea that cash production is, and is the story at the end of the day. Mm-hmm. At the end of any investment, you're looking to produce cash, right?
Yeah.
And so understanding where cash is being invested, where and how that investment is materializing from an operating perspective, I think is the true narrative of the business from my perspective.
Yeah. I'll tell you the other thing. Even that balance sheet can be. Even the financial statements can. I'll give you a true story. When I was with Bristol Myers mm-hmm. in Asia, and I remember that I got there, and the first year we had a great year apparently the year before I got there, and had the budget, and the budget was to do. I'm trying to remember the numbers now, but it was like we were going to do 300 million pesos in January. We did like 12. And then so we added the 300 to February's number, mm-hmm. and we're going to make it up in February. In February, we did like 30. Mm-hmm. So we were clearly nowhere near. Well, what was going on? Because revenue had completely dropped off. Were people not buying these products? Mm-hmm. No, it didn't turn out. It turned out that what had happened is we'd sold all this into the channels, mm-hmm. So we'd recognize the revenue months before the consumer was actually buying these things off of the shelf. So I'm always kind of very cognizant of the fact that just because how do you recognize that revenue? When I see that revenue, when does that revenue get recorded? Mm-hmm. Especially, another topic we had earlier with SaaS businesses. When do you recognize that revenue relative to when does something actually happen? Really important.
Absolutely.
Distinction.
Yeah. And I think there's a reason that there's three statements. Yeah. Even though depending on the business, it can be hard to use those statements to really understand what's going on operationally. The statements are all extremely useful in their intended purpose, within the context of what they are. And so they're meant to help tell that full story of the financial health of and trajectory of a business. It's
kind of an amazing framework of guardrails if you think about it. You got the debits have to equal the credits, and you've got balance sheet, income statement. Mm-hmm. How do they have to flow together? It does kind of constrain you. At some point you could do this, but then it's going to show up here. Or there's no cause without an opposite cause.
Yeah, and it's a good control framework. I think where financial statements, I quickly get bored with financial statements. Mm-hmm. For a company, not because they're not interesting per se. I'm a finance guy, so mm-hmm. Financial statements are somewhat interesting to me. But I think the most important thing about financial statements and assessing the performance of a company is not about the three statements just in actuals, but how does that compare to what we thought was going to happen, right? Yeah. And the health of a business isn't necessarily just its actual performance. It's its actual performance compared to what we thought was going to happen and what we're doing as a result of that, either positively or negatively. And so I'll do a cursory kind of review of the performance of the business on an actual basis to help me inform how the business operates and how the business executes and the result, where the big buckets of stuff that mm-hmm. I need to be aware of for a business are. But immediately I want to know, what does that mean in terms of what the company's doing, right? Yeah. What does that mean in terms of how they're thinking about the future and what they thought was going to happen, so that I know whether or not those results compare positively or negatively with what they thought was going to happen, because that tells me way more about what's actually going on in the business than just the actual results
It's
themselves.
so true. I mean, it's interesting. All the financial statements are always, year-on-year comparisons. Year-on-year can be okay, but there's a lot of nuances. But man, if you tell me, hey, I think I'm going to do X, and then you do X minus 2, that tells me a lot more. It tells me more about how much control you have over a business.
Yeah. It's the reason guidance is so important. If you look at it from a public company standpoint, it's not that guidance is an indicator itself of the performance of the business. It's an indicator of your ability to influence the performance of the business, toward objectives. And that's, I think the real value of guidance. And guidance is just a proxy for a budget. It's a proxy for a plan. It's a proxy for what do we think, we're going to make some decisions over the next X number of months or years, and those decisions we think, based on, the framework that we have, should yield Y. And that, and how are we doing against that? And that, when you're analyzing financial statements, I think limiting yourself to a 3-statement view of the world from an actuals only standpoint limits your ability to use those statements to their full potential, which is where, GL systems tend to fall down a little bit, because they can't produce the full picture, because they, generally speaking, only produce the historical view of what actually happened, not what actually happened compared to what you thought was going to happen, and a view into what that means going forward.
Yeah, you're right. The truth is, by the time you get the financials, you're already looking way ahead. Nobody cares. I mean, I get mine every year in February, March. I start to get mailed copies of, because I'm scared to go to paperless entirely. I get all these copies of financials, but by the time I got them, I'm like, who cares? That was yesterday's news. Especially now, because a lot of companies have stopped putting their management letter, or stopped putting much in it, except the SEC filing. Except for the Berkshire Hathaway, they have a nice. I always like that letter.
Yeah, I mean, look at it from a private investor standpoint. How many private investors just want a trended income statement? It's not what they want. They want a trended income statement and a comparative, right? They want to be able to look at your performance on the statements relative to something, year over year, right? Budget, most recent forecast, things like that.
Yeah, I love I had a controller one time at Bristol Myers Squibb, and he said, missing your guidance in his mind is an internal control breakdown. And I don't know, I mean, unless there's a good reason for it, I guess. I agree with you. Forecasting, I always say forecasting is kind of like, if you do, well, what we believe, which is kind of monthly forecasting, but it's like running an experiment month after month after month, and the more you do the experiment, the better you're able to incorporate the new observations into the hypothesis.
So when we look at analyzing financial statements, that's really where the analysis, I think, yields fruit. It's what changed month over month and why, or year over year and why, and from an actual standpoint. But the real decisions come out of what happened that was different than what we expected to happen, and that's where I tend to get the most value from financial statement analysis.
Though I gotta say, I read some of these annual reports that come out, and they'll say things like, or the MD&A, and it'll say things like, payroll expense went up because we hired more people. I'm like, oh, okay. Or we hired more people and also paid some people more and some people less. That's really helpful. I learned a lot about that.
Very helpful. Yes. I admire you being willing to still look at public filing documents.
And risk. The other one are the risk factors. Yeah, I know. I don't know why I look at it. I always do. Do you look at risk factors at all when you look at public?
I don't. I mean, I'm much more interested in private companies than I am public companies, because I think if you're looking at a private company, you can have a real conversation about, you can have a real conversation. You're not just reading a staged document. There's value in those documents. I mean, they are the performance of the business, but it's just much less interesting to me.
It's financial statements as, do you want financial statements to actually show you how you're doing so that you can improve, or are they performative financial statements where you're trying to prove to somebody else that you're doing a good job,
Right.
that things are going well. And I think they're completely different purposes. And I kind of feel like that's where, it's very hard to know how a company is really doing based purely on their I mean, obviously if they're doing amazing, you can see it, but public company financial statements really don't show you that much. Even though I believe in the GAAP. I better say that I'm a CPA, so I believe GAAP. But GAAP is kind of it's like lease expense. I want to think about how much money do I have to pay in rent over this time. But now we have a client who, I mean, that's all their company does is help you figure out how to calculate lease expense, and it shouldn't be that complicated.
Yeah, I mean, I think as finance, particularly FP&A professionals. We need to recognize the benefits and weaknesses of financial statements and help move companies toward a framework that allows them to truly analyze. It allows us as the people helping them make decisions, but also them trying to operate the business to have the information to supplement the financial performance in a way that helps them make those decisions. And that's where, when you look at a management reporting package, or a board reporting package, or something that actual operators use to make decisions off of, it never includes just financial statements. It doesn't tell the whole story, right? So all it does is help orient you to the performance of the business such that you can have a more informed understanding of the collective set of information that helps you understand what to do next. So you look at a management reporting package, what's in there? There you got financial statements, you've got comparatives, you've got metrics, you've got some trended data, you've got year-over-year data, you have to get to this holistic view of performance and what is real, and how does what is real relate to what we thought would be reality.
Yeah. It's interesting when I look at the government stuff. I mean, I always, my personal belief that we've had far too many lawyers running the country, and we ought to have a few accountants in there creating a framework that would actually make sure that, things work.
Maybe some FP&A people.
Yeah, I agree. Yeah. I think that should be our next gig.
Yeah.
But
finance for president. Yeah.
Anyway, well, that's just an introduction on how two people think about financials. There's a lot of ways to look at that. A lot of people analyze a lot of different things, and I know there are a lot of people who are always trying to figure out that angle to looking at financials that will tell them something more than somebody else can get gleaned from the same data. But
don't get lost in the noise.
Yeah, that's for sure. Yeah, go right to figure out what the key things are, and that's why we talk so much about metrics and analytical frameworks, which often are not. What is the famous Einstein quote? I don't think he actually said it, but everything that can be counted doesn't necessarily count, and not everything that counts can be counted.
Yeah.
And
something like that.
But I don't think he said that. Someone else said it, and then Einstein somehow got credit for it, and I always felt bad for that guy.
It's a good concept, regardless of who said it.
A great quote. He loses to a guy who's already getting plenty of credit for things. Anyway, anyway, with that, I will wrap it up. Another episode of FutureView Fireside Chat, and thank you very much.
If you're looking to rapidly transform your finance function, visit us at FutureViewSystems.com.